Oh, I mean, gold all day long because gold's going to go to 5,000. I mean, that's what I see, and I hate that. I mean, maybe it might take a couple of years to do it, but it's going. It's motoring. Yeah, it's begun. Whatever it is that gold's doing, and then whatever it's doing, why it's doing it, it's not doing it by accident. It's going. It's on its way. And as gold is for, I'm not really very happy about that. And I really, you trade what you see, not what the market doesn't care what I think. I have to pay attention to it, and I have to watch. Oh, the way you're doing that. What's going on there? Oh dear. If that breaks out, it's going to run. Oh, it breaks out, it runs.
After surging toward the $3,000 per ounce mark, gold prices have taken a sharp plunge, retreating from their highs. However, the gold bull market may not be over yet, as central banks continue diversifying their reserve assets to mitigate risks associated with the US dollar. Despite Friday's decline, gold secured its seventh consecutive weekly gain, marking its longest winning streak since 2020. Clem Chambers, founder of ANewFn, emphasizes that the key factor in gold's movement is its trajectory, an accelerating ballistic curve, much like a rocket taking off. He predicts that gold will reach $5,000, though it may take a few years. Nevertheless, he believes the upward momentum is already in motion. Gold is for war, he noted, suggesting that its rapid rise signals growing geopolitical and economic instability. Both risk-off sentiment and the ongoing de-dollarization process fuel the increase in international gold prices. In recent years, the U.S. Federal Reserve has consistently turned to quantitative easing during each economic cycle, even resorting to unlimited QE. As the supply of dollars expands, gold prices in U.S. dollars naturally trend higher. The World Gold Council, WGC, maintains a cautiously optimistic outlook, forecasting steady growth for gold prices in 2025. According to Chambers, gold's surge indicates the presence of a significant hidden variable, an underlying systemic issue that is intensifying. While he has his theories, he believes the Federal Reserve's policies are likely fueling these unseen risks, much like how unchecked derivatives contributed to the financial crisis 2008. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update.
But the key thing to see there is the shape. It's an accelerating ballistic curve. It's a rocket taking off. Well, obviously, if it's an Elon Musk rocket, it goes straight up. But you see what I mean? It's accelerating up. All bubbles accelerate up like that. That's such a bullish mark. The bad news is that it represents a sentiment that's really not very nice. Gold is for war. And it's something, there's an acceleration going on there. And what is that acceleration? You see, what happens for most of your viewers, they'll be going, what the hell is he talking about? But if you take a Black-Scholes formula, which is really the core valuation metric, and that's what the option markets work on. And if you want to believe that those equations are not very powerful, go try to beat that system, and you'll lose your shirt pretty damn quick, right? And that's an equation that says these are all the factors that go into a price, right? Now, there's always a lot more factors hanging off that equation. Yeah, because markets change, factors that are not important today are important tomorrow. I mean, the whole credit crunch was caused by counterparty risk. And there's nothing in the Black-Scholes about counterparty risk. You can write it in. You can write counterparty risk in and do another valuation. But that was a hidden variable, what I call hidden variable. But when you can see all these variables, but there's a whole load of hidden variables you can't see, the market will push all the risk into the hidden variables that you can't see. And if you want to make money, you better go looking for them, finding them, working out what they mean, working out how that changes the price, and seeing whether the price today is different from your new model. So the hidden variables is what happens, okay? And they get bigger and bigger and bigger and bigger and bigger, boom, bubble, bust, because they take control in the same way as all those crazy derivatives that you hadn't even heard of in 2008 almost blew up the world. They were the hidden variables. Okay. Now, when gold does that, that means there's a hidden variable. And what you have to understand is, what is it? I've got my theories. I might be wrong. What did the famous film producer say? I'm not always right, but I'm never wrong. Yeah.
Well, tell us your theory.
Sorry?
Tell us your theory then for the hidden variable.
Well, there's a hidden variable there. Something is going on. And when you look at what the Fed's doing, it will, by its very definition of what it's doing, be creating these hidden variables that may or may not be growing and getting out of control. Yeah, just like these derivatives did in 2008. Well, I mean, I think this is actually it's demonstrating an increase in volatility, global volatility, and when uncertainty increases, you've got to hedge it, haven't you? You've got to back something that gives you protection from increasing volatility. Now, the thing about volatility is not a bad thing. In fact, it's a great way to make money. Volatility is what every trader wants. Yeah, but there's some things when you've got volatility that you want to buy because it gives you protection, and gold is protection. And gold is protection from this volatility. And I would say that, I mean, if you look at the current American government, it's either great news or it's catastrophe. And, you know, it's a fairly large amount of people that will say it's catastrophe. And there's a fairly large amount of people that say it's the best thing that's happened in 20 years in America. That is increased volatility. Now, how are you going to hedge that? How are you going to put some money aside to make sure that you've got your rear end covered from if it turns out to be catastrophic? Well, there's really only one place to go, and that's gold, isn't it? So I think what you're seeing is an increase of volatility, or you could say danger.
Gold has proven to be a top-performing asset since 2000, delivering returns that have outpaced significant stock market indices, including the S&P 500. Over the past 25 years, gold has appreciated 9.99 times in USD terms, more than doubling the returns of the S&P 500, which has grown 4.34 times during the same period. This substantial outperformance highlights gold's role as a preferred investment for global investors seeking stability and wealth preservation. Clem Chambers emphasizes the striking divergence between gold and the S&P 500, noting that while the stock market has remained relatively stagnant, gold has been on a steep upward trajectory. Since Trump was elected, suddenly gold is going ballistic, while the S&P 500 remains flat, he observes. Chambers suggests that investor optimism is helping to sustain equity markets, but rising uncertainty and fear are fueling gold's ascent. Now let's redirect our attention to a video.
It's the international hedge, isn't it? It's the global hedge that has no currency, that has no politics. So it is totally apolitical, a governmental. It holds no opinion whether you're an angel or a devil. So, you know, that historically has been its purpose. And, you know, my catchphrase, gold is for war, it encapsulates that. But, you know, war is a metaphor for increasing danger. And does anybody think there is an increasing danger? So it's going to go up. But the point is, it's a ballistic curve. So as far as the market's saying, is that it's an accelerating situation of increasing tension, an accelerating increase in volatility. So it's that acceleration that is the base of a ballistic curve that you'll find in every single boom bubble bust for the last 100 years. You know, you could jiggle, jaggle, jiggle. That's one thing. That's linear. But that since 2025, it's now formed the base of what could become a ballistic price increase. And personally, I wish I could. I'm not looking at it. I don't want to see that. I want a nice little price, you know. I don't want to be the richest man at the gates, at the pearly gates.
Gold just looks like it's following the S&P 500 on the periphery. Take a look at this. I've related with the S&P 500 in the purple.
The S&P 500 is going sideways and gold is going ballistic. That's what I see. I mean, you've got since Trump's got elected, suddenly gold's going ballistic. And you've got the S&P going sideways, which I think is fortunate because, I mean, you know, if people get too frightened, it's going to go south, isn't it?
Well, okay.
It's good.
So
there's a balance of optimism there that's keeping the equity markets up, and long may it continue. Let me first of all talk about NVIDIA. Okay, it's not to say NVIDIA isn't through the roof. I personally hold AMD as a metaphor for AI because it is cheap, and it might be a mistake because if you're going to hedge your NVIDIA position, you're going to hedge it with AMD. So the market's going to be short AMD and long NVIDIA, aren't they? If they're, you know, into hedging. So that may be not necessarily the smartest move on earth. But anyway, the point is that the AI boom, the stuff that it drives, is not about a model being played, i.e., oh, I've got all this data And, please tell me the future of egg prices or whatever you're asking the AI to do. It's the training data. That's where you need the machines. That's where you need the cost. And it doesn't matter whether the Chinese have stolen your data and are running it on a player that's so much cheaper. The training is not going to go away. The training is still going to be infinite demand for the hardware that trains the data. And that's what all these NVIDIA chips have been used for, the training, not the actual using of the data, because it builds the vast network of inferences that costs you $100 million worth of electricity. And then it says, here you are, it's 2 terabyte. You can fit it on a smart stick, the result. But to get the result, you have to spend $100 million in electricity and thousands of these blooming NVIDIA chips to get the data set that the AI player plays. So it doesn't matter DeepSeek or whatever it's called. It doesn't matter what they've done. It doesn't lower the demand for the training hardware that NVIDIA makes. It doesn't lower the demand for cooling for all those machines, boiling the oceans. It doesn't change that at all. The only thing that would change that are people that come up with a better way of doing it. And then you still need more of it. There's no limit to how much intelligence you want. There's no limit to that. There's no limit to demand. There's no second place. It's not like crypto. There's no limit to how many of those machines that you're going to want. But very, very faintly, that's noise.
Is the NASDAQ primed for a 2000 style correction? Bubble pop.
It doesn't look like it, but put 5 years on there.
All right.
It's a straight line, isn't it? And there's maybe a little bit of a toppy thing, but you've seen that before. It's a straight linear line up. If you look at gold, there's that power curve. There's that acceleration. Yeah. There's no acceleration there. It's absolutely linear. And my idea is that some time in the next 2 or 3 years, later than sooner, because I always kind of see these things a little bit too early or way too early, there will be an acceleration and there will be a bubble. And then that will tell you it will be doing what gold's doing, which is it will form this suddenly zoom.
Gold has proven a resilient and high-performing asset, consistently outpacing major stock indices over the past 25 years. Its accelerating rise reflects growing global uncertainty, central bank diversification, and a shift away from reliance on the US dollar. Amid increasing economic instability, de-dollarization, and monetary policy shifts, gold remains a reliable hedge against inflation and systemic risks. The divergence between gold and equities highlights the contrasting forces of market optimism and rising geopolitical concerns. As financial markets navigate these uncertainties, gold remains crucial for preserving wealth and mitigating risk in an evolving global landscape. Do you believe fear drives gold prices more than actual economic fundamentals? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.